Okay, we'll wrap up chapter 7 here with this video. We're going to look at the disposal of assets. And there's a few ways a company could dispose of an asset. They could retire it. The company just simply disposes or throws away the asset as having no value. You might hear that called junking the asset or scrapping the asset, depending on where you're at, probably. But here we go. You could also sell it. Now that would be preferable, of course, to scrapping it. Could exchange it or trade it in on a new model maybe, or perhaps even trade with another business. They had an asset they needed to dispose of and you needed it. You might could work out a mutually beneficial situation there. Or you could donate the asset, of course. Could be some tax benefit there. That's for another course. All right, so let's look at disposing of an asset here. All right, problem 1. Let's take a look. Here we're dealing with a fire loss and how we would handle that in journal entry form. We got Masterson Supply purchased a small storage building for $20,000 to be used over a 5-year period. The building has no residual value, so it's just on the books at its cost of $20,000. Early in January of the 4th year, so essentially 3 years in, the storage building burned down. Assume the building was not insured. You guys, I guess that goes without saying, but that's a terrible position to get caught in. If you own a building, insure it. You don't want a fire to cost you the entire building. Anyway, that goes without saying, I guess. But first, what we're going to do here is calculate how much depreciation would have been taken by the time the asset was lost in the fire. So we were 3 years in. They're using straight line depreciation. So we'll calculate annual depreciation as cost divided by the useful life in years. That gives us $4,000 of depreciation expense per year. And again, we're 3 years in because it burned in early January of the 4th year. So we're 3 years in, so we'll take that annual amount of $4,000 and multiply it by 3 years. And that gives us our balance in accumulated depreciation by the time the building was lost in the fire. Right? So at the end of year 3, accumulated depreciation was $12,000, and just a few days after that, in early January, it was lost in the fire. So the balance in accumulated depreciation when the fire occurred was $12,000. But you guys, if this building is gone, we need to take it off the books. And we're going to look at how we do that. Well, accumulated depreciation, not only is it a $12,000 balance, but you know which side. It's a balance on the, hope you got it right, the credit side, right? So to wipe that out or make it zero, we're going to debit the account for $12,000, the amount of its balance. That brings it to zero. Now, what other accounts are on the books associated with this storage building? Well, it's the building itself at its cost of $20,000. Went on the books as a debit, like any other asset. To take it off the books, we'd have to credit the building account for $20,000. Now, you're probably noticing the entry doesn't balance, right? We know the debit side and credit side have to equal. So here, to balance the entry, we need more on the debit side. Sorry for that. This happens to me in face-to-face class, too. There we go. Sorry. You probably didn't need a news update in the middle of this. But anyway, we've wiped out accumulated depreciation with a debit. We've taken the building off the books with a credit. But now to balance the entry, we need more on the debit side. I did it again. I'll try not to do that again. I'm sorry. I really don't know how I'm doing it. But anyway, let me try that one more time. To balance the entry, we need more on the debit side. But you guys, if you get to this point and you need more debit to balance the entry, you have had a loss. We'll call it loss from fire. You could see something like loss from tornado as well, right? Or flood. But to balance the entry, we needed $8,000 on the debit side, so that's the amount of our loss. Had we needed more credit to balance the entry, we would have had a gain. Of course, uninsured fire is going to be a loss, not a gain. But anyway, we'll treat losses like expenses. We'll treat gains like revenues. They're very similar. Just revenues are earned in the normal course of business operations, and expenses are costs incurred in the normal operations of the business. A gain or loss would either be unusual or occur infrequently. And let's hope, of course, a loss from a fire is infrequent. It's not really unusual. But anyway, we'll treat the loss like an expense, so our losses or expenses increased, causing net income to decrease. See, they behave like expenses. And through retained earnings, it would cause stockholders' equity to decrease. And then our asset also decreased by 20, but the accumulated depreciation being wiped out would increase assets because it's no longer deducted, would increase assets by $12,000. So the net effect on assets was a decrease of $8,000. All right, what else have we got? I'll try not to show you any more news. That happens to me going, I know I said this already, but that happens to me going through these in class, and I guess I'm just scrolling over probably the weather right there. That's it. I got my mouse in the wrong place and popped up the news, right? All right, let's give the next one a shot and bring this thing on home. Problem 2, we got Kelly Company owns equipment that cost $70,000 when purchased January 1, 2024. It has been depreciated using the straight line method based on an estimated salvage value of $10,000 and an estimated useful life of 5 years. Prepare Kelly Company's journal entries to record the sale of the equipment in these 4 independent situations. The company last recorded depreciation on December 31, 2026. So let's talk about this for a second. It was placed in service at the beginning of 2024. It cost $70,000 with a $10,000 salvage value. So let's get out our old calculator here. We've got $70,000 minus $10,000 gets us to our depreciable cost of $60,000 divided by the useful life of 5 years gets us to $12,000 of depreciation expense per year. And it's been in service in 2024, 25, and 26, right? So 3 years so far. So the balance at the end of 3 years in accumulated depreciation should be $36,000. So what happens here if we sold this equipment for $38,000? Well, to take it off the books, we would debit accumulated depreciation. First off, since it was sold on January 1, 2027, there's no partial year depreciation to record. You're going to have some coming up, but we can skip that part for here. So let's go into our entry. If we sold it for $38,000, we would debit cash $38,000 to increase its balance. So the asset increases on the debit side. Okay, our accumulated depreciation. Remember, it was $12,000 per year. We're 3 years in, so it's got a credit balance of $36,000. To make it zero, we would debit accumulated depreciation for $36,000. And of course, the equipment itself, which was on the books at its cost of $70,000, would need to come off the books. It's an asset, comes off the books on, or decreases on the credit side. All right, now again, our entry doesn't balance, right? On the debit side, we've got 74,000, only 70,000 on the credit side. So this time to balance the entry, we need more credit. That means we had a gain. We'll call that gain on sale of equipment. What comes after gain or loss just describes what created the gain or loss. And so here we got a gain on sale of equipment for $4,000. So what does that do up here? We'll treat gains like revenues. So gains increased by $4,000, causing net income to increase by $4,000. Through retained earnings, that would cause stockholders' equity to increase by $4,000. And the net effect on assets was an increase of $4,000. Let's go through that. Equipment decreased by 70. And then the increase in cash would increase assets, of course. And then the decrease in the contra asset would also increase assets. So assets increased by 74,000 and decreased by 70,000. So we have a $4,000 net increase in assets there. All right. If we sold the equipment for $28,000 on May 1st, 2027, well, here we're going to have partial year depreciation to record. It wasn't sold conveniently at the beginning of the year. So we've got January, February, March, and April, 4 months of depreciation to record for 2027. Let's go back to our calculator. Our depreciation expense per year was $12,000. And here we need 4 months worth, so times 4 divided by 12. Should be $4,000 of depreciation expense taken for those for those first 4 months of 2027. We'll debit depreciation expense there for the $4,000 and credit accumulated depreciation. Now that increases expenses, causing net income and stockholders' equity through retained earnings to decrease, and the increase in the contra asset decreases assets. You guys, I didn't mention this on the last one, but if we sell property, plant, or equipment, that would increase cash flow from investing activities. Remember, property, plant, and equipment are considered investments for the business as far as cash flow goes, or really for any other reason too. All right, now we recorded this partial year depreciation here. Let's also record the sale for $28,000. Well, we now have that much more cash, right? So we'll debit cash for $28,000 to increase its balance. Asset increases on the debit side. Our accumulated depreciation would be the $36,000 from the first 3 years and $4,000 for the partial year. So accumulated depreciation here is going to have a balance of $40,000. Credit balance to bring it to zero, we debit it for $40,000. And then we know we want to credit the equipment itself for its cost, $70,000. Now let's see, does the entry balance? Did we break even on the exchange? No, we didn't, right? We got debit total of $68,000, a credit total of $70,000. So to balance the entry, we need more credit. Excuse me. To balance the entry, we need more debit. We only had $68,000 on the debit side and $70,000 on the credit side. So to balance the entry, we needed more debit. If you need more debit, you have a loss. If you need more credit to balance the entry, you have a gain. Now, just note that balance is right. You got $70,000 on the debit side and $70,000 on the credit side. And that would be cash coming in from selling an investment. We'll treat the loss like an expense. So losses increased by $2,000, causing net income and stockholders' equity through retained earnings to decrease by $2,000. And then the net effect on assets is a $2,000 decrease. Let's go through that though. The asset equipment decreased by $70,000. Cash increased by $28,000. And accumulated depreciation, the contra asset decreasing, has the effect of increasing assets. So assets increased by $68,000, decreased by $70,000. So that nets to a $2,000 decrease in assets. And looks like that's it for Chapter 7, you guys. As always, please be in touch if I can help you. And thanks a lot.